Hello, everyone. Hope you're all preparing for the new year. We only have 2 more days to go before we enter 2019. Well, today I want to share with you an article where Goldman Sachs came out talking about how they're reducing their GDP growth forecast in 2019, reducing from 2.4% growth to only 2.0% growth. And this is very important for investors because this might be signaling that the U.S. economy might actually be slowing down. So in today's video, I'll kind of talk more specifically about what Goldman mentioned, why they believe that way. I'll also want to show you a historical graph on the U.S. GDP, just so you have a better idea of where does 2% stand, as well as I'll be talking about the Trump's tax cut and how that really pushed up 2018's GDP number and why that sugar rush will be fading away in 2019. So let's get started and jump straight into the article from CNBC. So essentially in this article, they're saying that Goldman, again, is projecting a reduction in GDP numbers in 2019, all the way down to 2%. However, they do want to emphasize that they don't see any true signs of a recession, at least not yet. But all of that, of course, as you might know, might change later in 2019. And the main reason for Goldman Sachs to really downgrade the GDP forecast is essentially because of two things. Number one is a more volatile financial markets. As you can see, really since October, the S&P, Dow Jones, and NASDAQ, they've all taken a plunge. They're down about negative 15% so far from the peak. And the second reason for the downgrade is really for softer economic data. This probably, they're probably referring to like the unemployment rate that might actually tick up in 2019. Now, they do want to mention how, again, there is no worry about a recession yet, but I feel like with these kind of calls, it's always hard to really navigate or to even pinpoint. But nonetheless, a slowing GDP number, let's put all this into perspective for you. So here's a very, actually pretty cool chart here where it shows you the GDP number of the U.S. ever since in the 1950s until today. As you can see, historically speaking, GDP numbers actually hit in the double digit in the earlier stages in 1960s and also like the 1970s, whereas now GDP numbers are much more in line with the maybe anywhere from like 1 to 3% on average. And the reason why is because the U.S. economy is much more mature. Whereas when you look at emerging markets, say, for example, China or India, these emerging markets, they're growing at a 6 to 7 annual GDP growth rate because they're still growing. But the U.S., because we are more mature, we no longer have a very high GDP number. Now, I actually want to point you to another bar chart here where it kind of shows you more of the more recent data of the GDP numbers. As you can see, we've kind of always been in the past probably decade. We've been in this range of around 2%. So the fact going back to like what Goldman is saying, where they see the GDP number slowing down, is actually pretty in line with historical averages. And just something for you to know is that during the entire Obama period, GDP averaged only 1.9%. Again, this is in line with what Goldman is projecting. So because of that, the economy is still growing. The main thing we need to watch out for is just to make sure we're not getting negative GDP numbers. Because if that happens, that might actually be signaling a recession on the way. And just to kind of put everything into perspective, right? Like, think of like a sports car that you're driving on the freeway and you're going at 85 85 miles per hour. Well, now, the car is slowing down, and, you're no longer going at 85 miles per hour on the freeway. You're only going at 60 miles per hour on the freeway, which is still good. You're still trucking along, but you're not moving as fast. And the main reason why the car or the U.S. economy is slowing down is simply because of Trump's tax cut, where the effects are essentially fading away. Now, I kind of want to talk about essentially in this article, what essentially happened, right? So you all might know in the early 2018, Trump tax cut was able to pass, and as a result of that, corporations saw 1.5 trillion extra dollars being added to their bottom line, and if the belief here is that with that extra, cash for these companies, and also essentially seeing their corporate rate fall from 35% to 21%, these corporations, because they have extra cash, $1.5 trillion, they're then able to say, do more R&D, invest more in the company, and also acquire other smaller companies that would essentially boost their bottom line. And a lot of these corporations, for example, like Apple or Google, had cash overseas in the international countries. And when the tax cut dropped for them to 21%, they brought all those cash back, and that added to their balance sheet. Now, let's actually see what they did with the extra dollars, right? There's talks of this one chart here where it's essentially saying that a lot of it, the extra cash, went on to share buybacks, right? So a lot of these corporations, they bought back a record, Goldman Sachs is projecting a $1 trillion, used for share buyback in 2018. JP Morgan is projecting around a little bit over 800 billion, but nonetheless, this is much higher than historical averages. And because of that, I just want to talk really quickly about the implications of all the share buyback, and also the tax cut. So essentially, Trump's tax cut, because the government will now be collecting less in money, the government spending is going up, but their collection, their income is going down because corporations are paying less. And as a result of that, the government, you can see here, their federal budget deficit as of the end of Q3 in 2018 is about almost $800 billion. So really for the full year of 2018, that number is likely to surpass $1 trillion. And, longer term, what I would like to encourage you to think about is how the government will pay for all of this. So yeah, it's great that Donald Trump in Q2 2018, we saw GDP numbers hit 4.3%, but a lot of this is borrowing money to pay for the current stimulus for the economy. And that will likely fade away as we hit 2019. So really, going back to the forecast of GDP being slashed to 2%, 2018 was an exceptional year. Corporations paid much less taxes. As a result, they had extra cash to use on share buybacks, and also had additional disposable income to buy other investments within the company. And thus, as a result of that, we saw much more spending in the economy. However, that tax cut is likely to fade in 2019 because you can think of it as a sugar rush, and that will all go away. So as a result of that, the U.S. economy will be slowing down in 2019, and it'll be interesting to see what happens in terms of recession talks as we get much, much closer to, say, the end of 2019. So thank you all again for listening to this video. If you found this video educational and helpful, please drop a like and feel free to subscribe as well. If you post a comment, I promise you I'll reply back and I'll share with you my thoughts as well. So thank you all again for listening, and until next time, bye.